Now come to the next in the balance sheet. Next is, after discussion of the shareholders fund, we have discussed the shareholders fund. Share application money pending allotment is discussed. Non-current liability is discussed. Now our term is current liabilities. Under the current liabilities, under this heading, subheadings are short-term borrowings, trade payables, other current liabilities, and short-term provisions. So in the current liabilities, there are the four sub-headings under the current liability: short-term borrowings, trade payables, other current liabilities, and short-term provision. First of all, we will try to understand what is current liability. Current liabilities are those liabilities which will be repaid by the company within the operating cycle. Within the operating cycle of the company, normal operating cycle, it is expected to settle the amount within the normal operating cycle, or the amount will be paid by the company to their creditors or borrowings within 12 months from the date of the balance sheet. Within 12 months from the date of the balance sheet. So first of all, we will try to understand what is current liability. So current liabilities, here I have written current liabilities. A liability shall classified as current liability when it satisfies the following terms, following conditions. So criteria number 1, it is expected to settle within the normal operating cycle. It is expected to settle within normal operating cycle. It is expected to be settled in the company normal operating cycle, or it is due to be settled within 12 months from the date of balance sheet. The balance sheet which is reported from that date, within the 12 months, that will be paid by the company. Company is liable to pay that amount within the 12 months of the balance sheet. Third point is very important. If operating cycle cannot be identified in any company, operating cycle cannot be identified, then 12 months will be taken as maximum period, 12 months. So if operating cycle cannot be identified, it has to be assumed have 12 months. It is assumed to have 12 months. Fourth one is, if operating cycle of a period more than 12 months, if it is more than 12 months, means above 12 months, says 15 months or 18 months, all liabilities of that business which are due for settle within 15 days, within 15 months, here I have taken 15 months, so within 15 months of the balance sheet shall be classified as current liability. It means if the operating cycle is more than 12 months, for says 15 months or 18 months, then from the balance sheet date, if it is expected to pay within that period, within the operating cycle 15 or 18 months, then it's a current liability. 4, last one, if operating cycle is less than 12 months, if it is less than 12 months, says 8 months, 7 months, 5 months, 6 months, like that, so all liabilities that the business which are due for settlement within 12 months of the balance sheet date shall be classified as current liability. It is also classified as current liability if it is less than 12 months. Okay, because it is within the if operating cycle is less than 12 months, then it will be maximum period will be 12 months. Whatever the amount, the all liability that the business are due for settlement within 12 months comes under the current liability. So this is about the current liability. So liability shall classified as current liability when it satisfies the following criteria. Criteria number 1, it is expected to settle within the normal operating cycle. It is expected to be settled within the normal operating cycle of the company. Second one, it is due to be settled within 12 months of the balance sheet, date of balance sheet. Third one is, if operating cycle cannot be identified, then it is assumed to have 12 months. If operating cycle cannot be identified. Fourth one, if operating cycle of a period exceeding 12 months means more than 12 months, so all liability which the business are due for settlement within that exceeded period, suppose it is 15 months or 18 months or 20 months, so within that period of the balance sheet date, settlement within that period of the balance sheet date is considered as a current liability. Okay, suppose operating cycle is 12 months, so from the date of the balance sheet it should be 12. If operating cycle is of 18 months, so from the date of the balance sheet we will start counting 18 months. So up to that, whatever the liability comes, which will be settled within that 8 months from that balance sheet date of the balance sheet, that comes under the current liability. And if the operating cycle is less than 12 months, then 12 months will be your operating cycle. Maximum is 12 months. So if operating cycle is less than 12 months, says 8 months, 7 months, 4 months, so all liability that the business which due for settlement within 12 months, they comes under the current liability. So question is, what is operating cycle? Operating cycle means when the company purchase the raw material, on that time company pay the cash, and when that cash is realized by the company by sale of goods or services, this period is called operating cycle. This period is called operating cycle. For example, company purchase the raw material and it takes 2 months credit, purchase of raw material and 2 months time. Here 2 months purchase of raw material. After purchase of raw material, conversion of raw material into into the finished product, it is take 3 months time. 3 months time for conversion of raw material to finished product. When it is a finished product, the goods is held or stocked for 1 month. After 1 month, the goods is sold. So when the goods is sold on credit, the credit period is 1.5 months. Credit period is 1.5 months. So you add it 2 plus 3 plus 1 plus 1.5. So 2 plus 3 plus 1 plus 1.5, it is 7.5 months. So operating cycle here is 7.5 months. Means in 7.5 months, the money which goes out, that money comes into the business. Money goes out when we purchase the raw material, and money comes into the business when we sell it and the amount realized from the customer. So when the amount is realized from the customer, finally that period, the day the money goes out from the business and the day the money comes into the business by sale of assets, sale of finished product or sale of goods, finally that time gap is called your operating cycle. Operating cycle. So operating cycle is what? Operating cycle is the time gap. It is what? It is a time gap between the acquisition of raw material, purchase of raw material, and the amount realized by the sale of goods or services. That gap is called operating cycle. Maybe in some business operating cycle is very short, 1 month, maybe 7 days, maybe 2 days, maybe 1 day, and in some business operating cycle may be more than that, maybe 18 months, maybe 24 months, like this. Okay. Now see one question based on operating cycle. operating cycle and the period when payment is made is given below. How will you classify the following? How will classify the liability? Operating cycle, there the 6 cases is given. Case number 1, operating cycle is 9 months and expected period when the payment is received. First one is this one. First one is this. This is second. This is third. This is fourth. Fifth case, and this one is the case number 6. So under this situation, which one is the current liability? How will classify? So operating cycle is 10 months and expected period when the payment is received is 9 months, which is less than the operating cycle. It means it's a current liability. It's a current liability. Okay. Here the operating cycle is 10 months and expected period is 12 months, which is within the 12 months. So this is also a current liability. Okay. Case number 3, expected operating cycle is 10 months and expected period is 14, which is more than 12 months. So it's a non-current liability. Okay. Here the operating cycle is 15 and the expected period when the payment is received is less than this. Case number 3, operating cycle is 10 and expected period is 14, which is more than the 12 months. That's why it comes under the non-current liability. Case number 4, operating cycle is 15 and the expected period is less than that. So it's a current liability. Fifth number case, operating cycle is 15 and it is 18. Expected period within the payment is received is 18. So it's a non-current liability, which is more than 12 months, more than 15, it is exceeding 15 months. That's why here also the operating cycle is 20 and expected period of payment is 18. So it is current liability. Is it clear? Current liability. So here case number 1, case number 2, case number 4, case number 6 are current liability. And case number 3rd and case number 5th, they are non-current liabilities. Is it clear? They are non-current liabilities. So see the non-current liability, operating cycle is 10 and expected period is more than 12 months. It is 14, which is, and also more than the operating cycle. That's why it's a non-current liability. Same with the case number 5, operating cycle is 15 and expected period of payment received is more than 12 months and more than the 15 months. That's why it is non-current liabilities. Okay. So this is the answer. Okay. Now come to the current liability. First one is short-term borrowings. Short-term borrowings means borrowings which are due for payment within 12 months. Borrowings which are due for payment within 12 months of the balance sheet date. That borrowings are called short-term borrowings. Example are loan payable on demand. It may be a cash credit or bank overdraft. Loan from other party. If the company has taken loan from the other party to whom the company will repay the amount within the 12 months of the balance sheet date, then that is your short-term borrowings. Similarly, if the company accepted deposits whose payment will be done by the company within 12 months of the reported balance sheet, then that comes under the short-term borrowings. Similarly, other loans and advances, we have to specify the different natures. Nature has to be specified. If the company has taken any other loans and advances from the public, then and that amount has to be repaid by the company within 12 months from the date of the balance sheet, then this comes under the short-term borrowings. Next is trade payables. Next is trade payables. When the company purchases the goods or raw material on credit from the supplier and the amount has to be paid by the company within the 12 months from the date of the balance sheet to the supplier, okay, so that due amount comes under the trade payables. In trade payables, trade creditors and bills payable both come under the trade payables. So trade payable consists of trade creditors plus bills payable. So trade payable consists both trade creditors plus bills payable. So when the company purchases the raw material or goods from the supplier on credit and whose payment will be done by the company within the 12 months from the balance sheet date, then that comes under the current liability under the subheading trade payables. And in trade payables, both sundry creditors and bills payables both comes under the trade payables. Now come to the next, other current liabilities. After trade payables, other current liabilities which are due within the 12 months. Other current liability. Examples of the other current liabilities, I have written over here the examples of other current liabilities. Number one, current maturity of the long-term debts. Suppose company has taken the loan from bank for 5 years, then this loan is considered as a long-term loans. This will be shown under which heading? Under the heading non-current liability. But if the loan, the period is now, the repayment period now comes close, now it is only 12 months from the reporting date of the balance sheet, now the loan will be repaid by the company within the 12 months, that long-term loans, then that will be converted into a current liabilities. Means current maturity of the long-term loans. Current maturity. Suppose the company has taken loan for 5 years, first year, second year, third year, fourth year and fifth year. This year that loan will be treated as non-current liability. This year also non-current liability. This year also non-current liability. But when the company prepared the this year balance sheet, so from this date to this date, the period is 12 months. So this loan will come under the current liability over here, other current liability. In 3 years, the same loan will be under the non-current liability. The same loan for 3 years will be the under this non-current liability, but in the 4th year, the same loan will be under the current liability because the current maturity of long-term debts which comes under the 12 months, within the 12 months of the balance sheet, date of balance sheet. Interest accrued but not due on borrowings. Interest accrued but not due. Similarly, interest accrued and due, this also comes on borrowing under the current liability. Income received in advance. Unpaid dividend, dividend which was not paid by the company. So excess application money which is due for refund. This is in the case of over subscription, when the applicant has applied for more number of shares and company has allotted less number of shares. So the excess application money which is due for refund comes under the other current liabilities. Unpaid maturities, unpaid maturity deposits. The deposit is matured but it is not yet paid by the company. Deposits, the public has deposited the money which is due but not paid by the company. So that will come over here. Similarly, interest on that maturity deposit will also come under the other current liability. Next is other payables like outstanding expenses, calls in advance, unclaimed dividend. If the dividend is not claimed by any shareholders, sometime it may happen that no claim is done by any shareholders related to dividend. So unclaimed dividend. Provident fund payable, dues. Provident fund is due within the 12 months you have to pay the provident fund to the retired, the employee who has retired or who is going to retire. So who is going to retire within the 12 months of the last balance sheet, of the reported balance sheet, within the 12 months the employee is going to retire whose provident fund has to be paid. That will come under the other current liabilities. Okay. GST payable. GST is collected but not yet paid by the company, deposited in the government treasury. So the GST payable is also comes under the other current liability. So in the other current liability, current maturity of long-term debts, interest accrued but not due on borrowings, interest accrued and due on borrowings, income received in advance, unpaid dividend, excess application money which is to be refunded by which will refund by the company. So excess application money which is due for refund, and interest on that money if it is delay in refunding, then interest also be which is accrued comes under the here. On the surplus amount which is going to be refunded by the company, if company do the delay in refund, then the interest related to that component also comes under the other current liability. Unpaid maturity of deposits. Deposit is matured but amount is not yet paid by the company or refunded by the company or returned by the company. That also comes over here in the other current liability, and interest on that also come, interest accrued. Other payables are outstanding expenses, income, calls in advance, unclaimed dividend, PF, provident fund payable, GST payable, like this. Okay. Now next is short-term provision. After the other current liability, next subheading is short-term provision. So short-term provision are the provision against which the liability is likely to arise within 12 months. Likely to arise within 12 months. Examples are provision for bad and doubtful debts. Provision for bad and doubtful debts. Similarly, provision for employee benefits. If the employee is going to retire within 12 months from the reported balance sheet, so their provision related to provident fund or gratuity, that will come under the provision for employee benefits. And other provision like provision for taxations. Okay, this will come under the short-term provision. Means short-term provisions are the provision against which the liability is likely to arise within 12 months. Liability is likely to arise within 12 months. That type of provisions are called short-term provisions.